You gotta be flipping my flapjacks right on the floor. AMD stock down big here today. Stock down close to 7%. A lot of people want to know why, my opinion on perspective on this. So we'll react to AMD at the front of this video, and I'll share basically what's going on there in regards to AMD stock price, my opinions on it, perspectives, all those sorts of things. From there, we want to talk about Lululemon stock. The stock was down 18% here today. That stock is down 67% now from basically the end of 2023. It has just been absolutely obliterated. So Lululemon's now at very cheap valuations. People are looking at this and like, oh my gosh, the P ratio on Lululemon's at like 11. And we're going to talk about if this is the biggest trap or if this is the biggest opportunity. So I'm looking forward to sharing my perspective and opinions in regards to Lululemon there. Okay. From there, we want to talk about how to construct a great portfolio. I think that's a very important subject, and I'll give you guys some tips and just drop you some gems in regards to this. After that, I want to react to a few videos here. First one up here I want to react to is from 2 hours ago. Lululemon's running out of gas and it's not fixable. Looking forward to reacting to that one, sharing my opinions and perspectives. This one from Goldman Sachs, a job report shows labor market is softening. It basically implicates September cut. This should be an interesting one to react to hear where Goldman Sachs heads at, because wherever Goldman Sachs heads at, Wall Streeters in general are usually going to be there. And what the heck are my stocks doing in the background? We got Elf here, we got Nike here, what in the heck? And then Mohammed El-Alarian on his views on where the Fed's headed and what that means for the market, all those sorts of things. And then the very last thing we're going to get into here today in this video, this is something we put out in the Prep Stock Group, our weekly investor report. Just want to show you guys a couple important things so you can understand kind of where the market's headed from here and those sorts of things. Okay, appreciate y'all joining me as always. Thank you so much for being here. One thing only I need for you guys, just please hit the like button. That's all. If you just want to smash out that like button for me, that would mean the world. I appreciate every single person that does that, and especially the people that have already done that. You didn't even need me to tell you, okay? So, alrighty guys, by the way, if you want to subscribe to the channel, you can certainly subscribe. We're now at 107,000 subscribers, I believe, here on the reaction channel, so I appreciate each and every one of you for being here, okay? AMD, listen. First off, AMD stock since that April low is up 93%, as versus a QQQ, which is up 38%, as versus S&P 500, which is up 30%, okay? If we even want to pull up the other companies you want to compare against AMD, you would compare NVIDIA and you would compare Broadcom, right? You would compare those two companies versus AMD. And if we look here, and I don't know why my chart got all messed up here, it's from those April lows, we see Broadcom has outperformed with 114% gain. We see NVIDIA has underperformed those two at a 72% gain, and AMD is basically in the middle of the pack, right? So, and obviously it's crushed the market. I mean, there aren't many stocks that have returned 93% since that time. I mean, one of the only stocks I can kind of think of from that time period is probably Elf. Elf, 162% gain since then, okay? Celsius, I don't even know if Celsius is up that much from that particular April low there. Let's check out Celsius. Celsius is even up that much. Celsius up 72%, which is amazing, but it's just like it's not as much as the other ones, right? So the stock's been on fire. So what's going on here? Well, a few things. Broadcom announced a new customer, a fourth big customer. Now there's worries because Broadcom can do custom chips. If this is going to take business away from NVIDIA, if this is going to take business away from AMD and all those sorts of things, right? In my perspective on this whole subject, in what people got to understand about this is, I was explaining this actually on the main channel last night, there's plenty to go around for everybody here. Like, when you see the amount of money that's being spent and will continue to be spent over the coming years in regards to chips, this isn't some situation where it's just like one company is going to win the whole thing. NVIDIA got out in front of everybody, and NVIDIA has been the most direct beneficiary, right? After that, you could probably say Broadcom, and then after that, AMD, but AMD's really just at the very beginning inning of them kind of capitalizing on this. So the fact that people would kind of be freaking out over this is a little ridiculous in my opinion. Like a lot of companies, like Broadcom has like $1 trillion plus valuation on it, I believe. Like literally, I think Broadcom has $1 trillion plus valuation on this stock. Like they're going to have a lot of companies use them. Oh, excuse me, $1.4 trillion market cap. Broadcom's kind of a big deal, okay? So like, the fact that anybody thinks this is going to hurt AMD, no, it's not. AMD is going to put up phenomenal numbers over the next several years. They have the right chips. They have the right customers. And at the end of the day, people are going to continue to order a ton of NVIDIA chips. They're going to bump up orders for AMD chips in a massive way over this next few years, now that AMD's finally in the ballpark. And then Broadcom's going to benefit huge as well. And then you just heard about Amazon and their chips and the Trainiums. I believe there was a massive deal they're doing with Anthropic, if I recall. 3 massive warehouses. I mean, this is a big deal for a lot of companies. There's incredible amounts of investment going through and will continue to for the next few years. The question is this massive investment cycle last like 3 to 5 more years, 5 to 7 more years, 10 more years, right? But that's what's going on there. Now, the other thing that came out here today, and this also brought down the stock price of AMD, was this. An analyst came out and downgraded AMD. Now, it looks like this is the 7,137th best analyst out of 10,000 Wall Street analysts from what it looks like here, okay? So, it always cracks me up when these stocks will move based upon analysts' opinions and perspectives. But when you take an analyst downgrade that comes out on a day like today, along with Broadcom announcing another customer there, right? And like people worried like, oh, there's going to be no money for AMD to make, which is just ridiculous. It's going to affect the stock negatively. And so that's exactly what we've seen today. Is this a big deal for AMD over the long term? Absolutely not. It's literally going to be meaningless in the end, okay? Next up here, Lululemon. A lot of people are looking at this like, is this stock not a steal right now, right? Down 67% since the end of 2023, which the Qs are up 41% since then. S&P 500 up 36% since then. And people are like, Lululemon, what is going on here? Almost 70% drop. And I mean, it just shows no signs of bottoming, right? I mean, you look at a day like today, the stock was down like 18%. That's incredible. So in regards to the forward P, here's the issue. If you ever see a trailing 12-month P, the same as a forward P, the same as a 2-year forward P, you should get a little concerned. That could mean the company's profitability is getting in a scary place. Now, you might look at this and you might say, well, they're just supposed to be the same amount of profits. It's not usually how it works, right? Remember, forward Ps are going based upon analysts' projections for the next year, and 2-year forward Ps are the 2-year out, right? So when you see them all 11, you've got to be skeptical because usually companies don't stagnate. As with all things in this life, there's no such thing as stagnation. You're either getting better or getting worse at everything in this life all the time. So when I see 11 trailing 12-month P, 11 forward P, 11 2-year forward P, I say, no, it's not what it's going to end up being here, right? There's literally no such thing in this life as the same. You're always getting better or getting worse. You're either getting in better shape or worse shape, right? Your physical health is either getting better or worse. Your mental health is either getting better or worse. There's no like stagnant. You're either getting better or worse. That's everything in life. Your tree out there in your front yard, it's either getting healthier or it's getting less healthy. Like, it's just, that's life. And so when I look at a Lulu and I see 11, 11, 11, I'm like, I don't think so. No, that's not probable. What's either going to happen here is Lulu's going to turn things around and be much more profitable than analysts expect, or, which is probably more realistic, they're actually going to see their earnings per share go down quite dramatically over the next year or two, and that forward P is not 11, and it's going to end up being way higher than where it's at right now, which is not a good thing, right? So that's something to keep in mind. Additionally, the U.S. growth was basically, there was no growth in the United States. It looked like in the last quarter for Lululemon. That's scary. For a company like Lululemon that's supposed to be a growth company. Remember, Lululemon, we go back to the end of 2023, the stock was $500+. It was priced as a growth stock. So now we have a massive transition that has to happen, and it's an awkward transition. It's a painful transition whenever a company has to go through this, and it's important everybody understands this, okay? What you have happen is a company like Lululemon will go from having a growth investor base to a value investor base. But listen, that takes a while. Now, the value investors don't step in unless they're confident in that company's profitability over the coming years. If the value investors are not confident in that company's ability to generate net income and EPS over the next several years, they will not come in and buy that stock. they will not come in and buy that stock. And that's what you got to remember in regards to this. What is going on with this wind hat, by the way? It's got like a fuzzball thing on it. It's like bothering me. I usually wear my 1000X hats. Where are my 1000X hats at? Okay. So this is an awkward time to go through if you're Lululemon. You got growth investors saying, peace out, I'm out of this thing. And you got the value investors saying, I don't know if I want to step in this because your profitability is going down so fast. You got to understand, Lululemon's earnings per share was just down on a year-over-year basis. Down. We got earnings per share going down. We have margins going down. Their margins were going down also. And we've got no growth in the United States. Now people are looking at it like, Lululemon's about to go negative in the United States. Maybe that happens, maybe that doesn't. I don't know, but that's a true fear. When you start posting a goose egg for growth in the United States, people say, next up, negative. The question is, what are we going to see? Negative 2% growth, 5%, 10% revenue growth? That's scary. So the only growth they're really getting right now is China. Now, additionally, when you look at Lululemon, there's been a big change over the last couple of years in regards to this, and it helped out short-term revenue. And I understand what Lululemon's trying to do here, but here's the issue. So I just went to Lululemon, like the front page, and what am I greeted with? Just a bunch of like random clothes, and this is what they're becoming. And now if you go in their stores, they're selling all types of random clothes, and they're gotten big into men's over the past few years and all those sorts of things, right? And so Lululemon, like how they built this business was on the back of an incredibly successful yoga pant. Everybody knows that. It doesn't matter if you're a guy or girl, if you've ever done yoga in your life, everybody knows that, okay? That's how they built this into a billion dollar company. But now they're all about these other things, right? They're about trying to sell to men, trying to sell bags. They want everybody to be their customers. So now they've kind of gone wide here, and that's a tough thing. Sometimes it doesn't work. Now they want to sell you a polo. Now what happens is, okay, you want to sell guys polos, cool. All right, now you got to order massive amounts of inventory. What happens if the dudes say, you know what, I don't want my Lululemon polo? If ever guys out there, saying I want a Lululemon polo, that's great. You're going to sell those, at a phenomenal rate, and you're going to make crazy margins on it. But if you don't, you're going to sit on inventory. Then you're going to have to start clearancing. A clearancing's never a good look for any brand. If you ought to start having a clearance rack, ugh. Or then you can say you can just take the hit and maybe try to sell it downstream to like a Ross or somebody like that. Not a good look either, right? I mean, imagine, somebody that's your usual customer goes into Ross or wherever and they see your product. It's not a good look for a brand to really be in Ross and those sorts of stores. So this is what's going on for Lululemon now at this point in time, and that's tough because somebody said this recently, like Lululemon's trying to become the Gap. Here's the issue: Lululemon's got a $20 billion+ valuation on it. You know what the Gap has on it? $8 billion valuation. $8 billion valuation. Uh-oh. You want to become the Gap? You can do that. That means still another 50+% downside easily from here in regards to your stock price, right? Now, there's also been a lot of competition that's come in the space. This company named Alo has gotten very, very popular in the space. So, they got Kendall Jenner on the Alo. Interesting. So, yeah, this brand has been popping recently. They got this other brand called Viore, which is, gotten much more popular recently as well. So now they have serious competition. But here's the thing, and this is what I'm always pointing out, because people say, why would you rather buy Nike stock right now instead of Lululemon? Lululemon looks so cheap, right? Here's the issue, ladies and gentlemen, okay? Nike has a brand. Lululemon doesn't have a brand. Nike sells success. Nike doesn't sell clothes. Nike doesn't sell shoes. They sell success. They sell winning. When I went to get 1000X hats made, I said, can I get Nike 1000X hats made? Like, that's pretty cool. Why? Because I want to associate with winning. I don't associate winning with Lululemon. I don't associate winning with Alo or Viore or Hoka or On or any of those other companies. They're just brands. They're here for the hot thing at the moment and then they're gone, right? And I don't want to say gone as in like, they go bankrupt. They just they kind of go into irrelevancy slowly but surely. And they still have businesses. They still make money, right? Same thing with Reebok and Adidas and all the other brands and One, right? It's all the same thing. It's one company that actually spent countless tens of billions of dollars on their brand over the years, and they built a brand on success and winning, and built a brand on something more than clothing, and it's Nike. And they're the only ones to do that. And so when you ask me why I want to buy Nike over Lululemon, it's easy. Because Lululemon, I don't know where that brand is 5 or 10 years from now. It could be completely irrelevant. I know where Nike is, even more relevant than it is today. There's a big difference there. And so, and what that means for profits long term and all those sorts of things matter significantly. So, just a little something there for you guys, okay? Next up here, let's talk about how to build a great portfolio. I think this is an important subject, and then we're going to react to some videos up here, and then we'll get into the few things I want to show you in regards to the investor report to understand where this market's headed from here, right? But I posted this on X here today, right? I don't show the Patreon portfolio too often, other than obviously if you're in the Patreon, you get to see it all the time. But, in regards to Patreon portfolio, this is how you build a truly great portfolio in a pretty quick amount of time, because this was a portfolio I started when I started my Patreon, which was 2023. And the first year we did $150 a week, so not a lot of money. And after the first year, then we switched to $250 a week. So a small amount of money, right, can build a portfolio really quickly if you're a good investor. And so look at how quickly we've been able to build this portfolio to now $53,000 portfolio. I mean, honestly, in the next 24 months, this portfolio will probably be $100,000 plus. That's my guess. Probably in the next 24 months. Maybe it doesn't happen. Worst case scenario in the next 36 months, but I think there's a decent probability in the next 24 months, we're going to be looking at a Patreon portfolio with 6 figures plus, right? Which is incredible because it's been built with such a small amount of money. Such a small amount of money. This isn't like, like we're putting $10,000 a month into it, or like completely unrealistic amounts. Like, this has been built on extremely conservative amounts of money. But look at how well constructed the portfolio is across different industries. You got a Palantir, which is so much different than an AMD, which is so much different than Shopify, which is so much different than Elf Beauty, Wynn Resorts, Cheesecake, Nike. Like, these are just so many different great companies in different spaces. And the only stock I have that's red in there is Nike right now, right? Which I think if we fast forward a year or two from now, it'll be massively green. But it's not just that. When you build a truly great portfolio, you've got a portfolio full of growth stocks, value stocks, dividend stocks, GVD. I always preach it. GVD 1, 2, 3. Making sure you got 3 stocks in each category. And if we go through the portfolio, we've got at least 3 value stocks here, at least 3 dividend stocks, and at least 3 growth stocks, right? That's how you truly construct a great portfolio. Are they in different industries, or do you have a good mix of top tier growth companies, top tier value companies, and dividend companies? And if you look, like, oh my gosh, like you look at my growth stocks, are these not some of the best growth stocks you've seen? And remember, I took huge profits on Tesla, by the way, in regards to the portfolio. But, when you think about some of the best growth stocks in the market, right now and over the next few years, like Palantir is going to come to mind. AMD is going to come to mind. Shopify is going to come to mind, right? Elf Beauty is going to come to mind, and I own them. When you think about some of the greatest, value stocks, dividend stocks over time, companies like Wynn Resorts will come to mind. Companies like Nike will come to mind. Cake's been a great performer, right? Meta and Google now, even though those companies both have great growth, they're also kind of value and dividend stocks because of where those stocks trade at. So if we pull up the compare feature here on 1000X, you guys will see how cheap Meta and Google McDougal trade here. So let's type in both these ticker symbols, okay? And take a peek at this. So Meta forward P26, Google forward P23. These stocks trade really cheap, really cheap. I mean, the market in general is at a forward P of 20-ish. So they're barely above a market multiple, but the growth rates, look at next year expected growth rate from Meta, 17%. Look at Google next year expected revenue growth, 12.6%. Current year expected revenue growth from Meta, 20+%. Google, 14.5%. That's growth. Those are growth companies, but they're trading at value pricing, and they pay dividends. So phenomenal stocks there, right? And so anyways, the portfolio is just very well constructed. That's how you build a truly great portfolio. Do you own a bunch of different stocks in a bunch of different industries that are top tier companies, right? Top tier operators. And are they a good mix of growth, value, and dividends, right? By the way, if you guys ever want to follow me on X, I always have that linked in the description area of all my videos, okay? Let's go ahead and let's react to some videos.
In Lulu 3 years ago that others missed.
It was pretty simple. It's the core of the business
was running out of gas. And the company, as a result, was trying to expand beyond the core, selling sweaters, sweatshirts with logos on them, Little House on the Prairie skirts that were down to your ankles. That's not Lululemon. So the company we saw was basically trying to stretch for more growth, and it didn't work. So
pun intended.
Pun intended, yes. And now it's running out of gas.
Is it fixable?
It's not fixable because when they were growing very quickly, there was no competition. It was Lululemon was the it company in the it space, especially during COVID, which accelerated the growth of athleisure. What has happened since is there's a ton of competition coming into the market. Alo and Vuori are a big problem for this company.
There's an Alo store near me. There's a Vuori. I get the catalog.
Is it fixable? I think that's a great question. That's a very direct question. Is it fixable at Lululemon? The answer is not really. Not to a great extent. And the reason being is they just haven't invested in the brand the way they needed to invest in the brand. And they chose to make short-term margins and profits rather than focus on the brand. And listen, Nike could do the same thing. Nike spends billions and billions of dollars a year on sponsoring leagues and athletes and all this stuff. Nike could easily just say, you know what? Screw it. We're not gonna have the best athletes. We're not gonna have our logos all over the jerseys and all this sort of stuff. You know what? We're done with all that. And you know what happened with Nike margins in the short term? Skyrocketing margins in the short term. You know what happens to the brand over the long term? Destroyed, because over time Nike would stop being as viewed as like success, right? And so it just kind of like falters. And that's always the downfall of these companies. I've been explaining this for the last year or two in regards to this as I've been acquiring my Nike shares, right? Because people are like, well, what about this brand? I'm always explaining to them, you understand decade after decade, brands come and go in the apparel space. And the reason they come and go is consistently because no one understands the way you have to invest in your brand if you want it to be lasting for the next 40, 50 years. And Nike's the only company who has really understood it on that deep of a level, and that's why they remain relevant. I mean, Nike's been in the toughest times they've had in a long, long time over the past year or two. And guess what? Nike's worst times is still better than everybody else's best times. So, it's very important. You got to understand the strength of a brand when you're selling to consumers. It's massive.
The Alo store always appears to be packed.
Yeah.
I don't know who they are, if they're public. I don't think so. What are they doing right that Lululemon?
Yeah, in Alo, I mean, they could be super packed and super relevant right now, and 5 years from now, no one goes there. That's how it is with these brands. They come and they go, and they're just they're the hot thing, and then they're not the hot thing, because no one actually wants to spend the margin and invest in the brand the way you need to invest.
Maybe it's getting wrong. Just no ankle length skirts. I don't know.
I think Alo and Vuori they're sticking to their identity. They have a good casual offering. Their fabrications are great, and their marketing is on point. So what's really scary today is both Alo and Vuori separately have over 100 stores across the United States. That's a problem for Lulu because, again, 5 years ago, these companies, you've never even heard of them. A lot of people haven't even heard of them today, but they're...
Well, we had Athleta, right? Or Athleta.
Yeah, well, that's gets owned by the Gap. That's more irrelevant these days. But
even more irrelevant.
More irrelevant. But the problem with Lulu is actually the key is where it is relevance. It's still a relevant brand, but it's becoming less relevant to the consumer. They're losing their core customer, and that core customer is going to Alo and Vuori.
Well, let's talk about the consumer, because we have the jobs number out today, and it was much weaker than expected. You guys have had, it's a Wizard of Oz theme. Lions, tigers, and bears, oh my, on the consumer. What is that, and how do we read it? And who's going to win? Because somebody's going to win.
Yeah.
Or maybe not.
Great. Thanks for bringing up the Wizard of Oz. It's our negative thesis on the consumer. We talk about lions being negative mall traffic or choppy mall traffic, tigers being rising inventory. So inventories are rising in the retail space for the first time in a number of years, and they're now exceeding sales growth, which is pretty concerning.
Means good for TJ Maxx.
Well, good for TJ Maxx, yes, but not good for most of the mall retailers that are finally bears, which are at peak margins and earnings. So if you really think about this, 2024 was the best year for retail in 20 years. So if you take that and say, hey, wait a second, mall traffic is starting to get choppy and going towards a declining trend line. If inventories are rising faster than sales growth, if comparisons are at peak peak their best they've ever done. And finally, oh my, you bring in tariffs. That's going to be a problem for earnings per share.
Retail's a brutal business, man. I had to learn that over the years, over the last 17 years I've been in the market. Retail stocks, so hard to invest into. Brutal, man. I've tried to invest in many retailers. A lot of them I made money in, but small amounts of money. Small amounts of money. Like, oh, I made like 10% in the stock or 20%. Or, you know, it's tough to make money in retail stocks. I'm just going to be honest with you guys. Because it's like, they'll be dead in just dead stocks for years. Then they turn it around. And as soon as they turn it around, something bad happens in the economy or something bad happens with a tariff situation or something like that. Stocks are leveled again. It's just, they're probably the biggest, retail stocks are probably some of the biggest money traps in the stock market. Them and oil and gas stocks. Like, if I think about some of the biggest money traps, oil and gas stocks and retail stocks, because they'll make a ton of money at a particular time, and then, you know, the stocks will start going down before the business turns down, and then after the stocks already gone down, then the business actually starts going down, because they're kind of like very cyclical, and something happens, and it's just a mess, man. It's just a mess. So anyways, big money sucks. Retail and oil and gas stocks. Goldman Sachs.
To discuss, welcome back, Jan.
Hi.
Good to see you're still here after the president's assault, which we'll talk to you about in a moment. But just reaction on jobs to this weaker print.
It was a little bit weaker than we had expected, but we've been looking for a somewhat soft report with an increase in the unemployment rate, with a sort of sub-consensus job gain. I think the implication is that the labor market continues to be pretty slow. Hiring is very slow. Layoffs are still low, but the labor market's softening. And my main takeaway is that this seals the case for the cut in September that we've been looking for a while, and probably additional cuts beyond that. We have cuts in October and December as well, and I think that looks quite likely. Obviously, that's going to depend on the data, but I feel very good about the forecast.
There's also the...
So yeah, he's 100% right. You know, anybody that tries to gaslight you and tell you, oh, the economy's booming right now, it's amazing. No, baloney. It's not. It's also not a disaster zone. We're in an okay economy. Like, we've been in, honestly, for a while now at this point in time. It's not like this is new. I feel like we haven't had a booming economy really since kind of that 21 into very early 2022, right? And then as 2022 continued on, it felt like things started to slow. And then I feel like it's just the last, honestly, few years have just been kind of meh. And I feel like that's still kind of the situation. And it's like, you can't really call it it's no great financial crisis type recession going on where it's like, oh my gosh, it's devastating out here, you can't make a dollar. But it's also not boom times, which is kind of where you should be, to be fair. If you come off of a big inflation cycle, this is really what it should feel like. This is kind of what it should be like, right? And when the Fed's lowering interest rates, this is kind of what it should feel like. Like, you don't want to really be in a situation where you got a booming economy and the Fed's lowering interest rates. That means you're probably setting yourself up for a massive inflation spike if that's happening, right? We don't have that. Additionally, you don't want to feel like you're in a massive recession when the Fed's cutting, because then that just feels like, oh, awful. Like, they're cutting because they're in panic mode, right? So honestly, the economy we're in, the jobs market we're in, it's about where you should be given all the factors that we've had over the last 5 years.
Debate about whether the Fed can start cutting now and help shore up the job market. Does it work that way?
Well, that's the idea, that you move closer to neutral, and that supports the job market in a period during which hiring is quite soft. And yeah, at the margin, that should be expansionary and shore up the job market, as you say.
There was some discussion yesterday out of ADP that maybe the break-even was higher than we think, and that it might have resulted in a 4.5 print today on unemployment. Did that make any sense?
Well, 4.5 would have been a very large increase, so I thought, I don't think that was really on the table. Obviously, month-to-month changes in the unemployment rate can be noisy, so you always want to look at a range of different indicators. But we'd been looking for 4.3%, and that's what we ended up getting.
Yeah. And when it comes to Trump, let's be very clear. This is his time to 2025 has kind of been the year where it's just like, we're trying to put everything in place for 26, 27, 28, right? It's kind of still the Biden economy and all those sorts of things. But I'll be honest, Trump needs the economy to pick up significantly next year. There's going to be a lot of pressure for the economy to get moving. If the economy worsens next year, that's going to be a horrible look, because next year, all this big, beautiful bill stuff, all that starts to supposedly positively affect the economy, everything like that in 26 and beyond. So there needs to be a significant pickup in the economy in 26. We got to feel like, oh, now we're picking up steam. And I feel like we haven't felt like that yet in 25. I don't feel like it's like, oh, the economy's really picking up. We've got to get to that place in 26 or Trump's going to be in trouble come primary time. We got to feel like, oh, things are really picking up. Like the back half of 26 is going to be great. 27 is going to be great, right? If things worsen next year and it feels even like, oh, the economy is even slowing down more, it's getting worse, we're in recession or heading to recession, oh, watch out for that late 26 election, okay? All right, Powell's taken too narrow a view.
You have been fairly critical of the Fed. You've also been critical, but fair. And as the job market has been slowing for over a year, some, like the guy in the White House, are wondering why the Federal Reserve has not already begun to act on interest rates. Outside of those rather, some would say, bizarre cuts last fall, we asked my ex-audience, Twitter, what it thinks. I asked, by not cutting rates this year, the Fed is A, doing it right, or B, getting it wrong, Mohammed. 67% said the Fed is getting it wrong by not cutting rates sooner or more aggressively. Would you agree with that take?
I agree with the 2/3 who said that they have been getting it wrong. There was a bunch of us outside and inside the Fed that were arguing for a July cut. And our concern, which is playing out in the data, is that Chair Powell had taken too narrow a view of the jobs market. And by that, he was ignoring the weakness that was starting to come to the surface. And the problem, as you know, Brian, is if you don't address weakness in the labor market, it becomes non-linear. It accelerates and it becomes much more damaging. So yes, I think they have gotten it wrong. I think once again, they're late. They will cut in September. And I suspect there will also be a discussion, should they cut by 25 or 50? And where you end up on this depends on whether you think the labor market has a demand or supply problem and what you think the inflation dynamics really are.
Yeah, I agree 100%. They're late. My opinion there hasn't changed. All right, next up here, I just want to show you guys a couple things inside our weekly investor report. We put this out to the private stock group members each Friday afternoon usually, okay? And by the way, if you're in the private group and you never knew about this, we have a Discord tab and it says like weekly investor report or something like that. You can click on that. You can look at the past ones as well, right? And it's just to give everybody a snapshot of what's going on in the markets, the economy, things like that, because I understand not everybody can do this full time. Like a lot of our private stock group members run companies, they run their own little business, right? They work it, 40, 50 hours a week, so they don't have time to pay attention to every little thing going on in the economy. So this is supposed to be like a great snapshot into what's going on in the market, what's going on with the economy, things like that. And there's just a couple things I want to show you guys here. One is this is the latest AI investor sentiment numbers. Awful. It's still awful, man. Like, look at this number. 43% bearish, only 32% bullish. It's been overwhelming bearishness. And keep in mind, usually there's overwhelming bullishness. That's a usual market. There's been overwhelming bearishness since February, folks. Really since like the end of January. And you can look at the historical data. It's bad. So, but at the end of the day, like, market's been pretty good this year, right? Obviously, we had the drama show, the severe correction, but at the end of the day, like, it's been actually pretty decent, which is fascinating considering how bad things have been in regards to sentiment, right? Fear and greed index this week, kind of more at a neutral place. Last week was a little slight greed in regards to that, right? And then as far as the latest consumer sentiment numbers, they came in at 58.2%, which is down from July 61.7%. So kind of a surprise that consumer sentiment got worse last month. If anything, I was expecting that to get better. And once again, these are things that, earlier I spoke about, like Trump really needs a lot of this stuff to turn around. He needs in 26 consumer sentiment to be improving a lot. He needs the job markets to improve, the economy to improve, and the Fed to continue to lower rates. And then, come election time, the primaries, maybe things could be looking a little better. Or I can call it primaries. It should be midterms, right? Midterms. Midterm time, we could be looking better. If I'm telling you, man, if things get worse, if the sentiment gets even worse, if the economy gets worse, those midterms can be tough. So, keep that in mind. Okay, guys, appreciate you joining me as always. Thanks so much for being here. If you're looking to apply, join my private stock group, private wealth group. You want access to all the stuff you get access to in there, which is an incredible amount. All of my premium courses, stuff like this, my investor weekly report we put out to the private stock group members, our private Discord chat, right? Ability to see the stocks I'm buying and selling each week, all that good stuff. Pin comment down there, click on that, fill the form. Let's get you access in there maybe this upcoming week. Much love and have a great day.